Alright, so we need to talk. This market has been absolutely brutal lately. In only 2 trading days, the Nasdaq is down nearly 7%, with so many more growth stocks being down more than this. Take 3 of my own stocks, for example. Amazon stock is down 8.5% in the past 2 days, then Tesla's down about 9%, and worst of all, Shopify's down over 20% in 2 trading days alone. If you're a growth investor, it's highly likely that your portfolio is feeling the pain just like mine is, and nobody has any idea when this pain will start turning into gains again. So in today's video, I have a very important message I want to share with all investors, and we'll also be analyzing one stock in particular to try and figure out what might happen next. All I ask is that you mutilate that like button just like our portfolios have been lately, and if you haven't already, please consider subscribing so you don't miss out on any of my future uploads. With that said, let's get straight into the video. Now let's start by taking a step back in time to analyze one of the greatest growth stocks of all time, none other than Amazon. And the reason that I want to analyze Amazon specifically is because every other growth stock in this market seems to be getting destroyed, including Amazon, and we have a big history behind Amazon that might be able to tell us a little bit about the future. Now what you're looking at here is the chart of Amazon stock from 1997 to 2003. As we can see, ever since Amazon's IPO back in 1997, the stock went on an incredible rally from about $2 per share to $112 per share at the end of 1999. To put this into context, that is a 50x return in only 3 years. That is absolutely insane, guys. But then of course the dot-com bubble popped with the emergence of a recession, lasting until 2002, where Amazon stock finally bottomed and continued its rise upwards. So from peak to trough, Amazon stock saw a decline of over 90% in only a few years, where the market sentiment changed from pure greed to pure fear and then back to normal again. But despite this wild stock price volatility, what was happening to Amazon's fundamentals all the while through this 6-year period? Well, that's exactly what I'm going to be analyzing here, so I tabulated a little bit of data going back from 1997 to 2003 for Amazon. Starting off with the stock price here, we can see at the end of year 1997, Amazon had a stock price of $5 per share, split adjusted, which then went all the way to $90 per share at the end of 1999, then crashed to $17.50, and then $11 in 2001. Then of course the rally continued in 2002 to 2003, where it reached $52 per share again. It wasn't until about a decade later, in 2009, that Amazon stock finally recovered to $112 per share. Moving along, we can see here that Amazon's shares outstanding actually grew from 253 million outstanding to 396 million outstanding from 1997 to 2003. So just imagine this for a minute. You're invested in a stock that's dropped over 90% and the company continues diluting shareholders all the while. Now in terms of Amazon's revenue and how the business was actually performing underneath the hood, this is a little bit of a different story. Back in 1997, Amazon had revenue of $148 million, which then grew to $610 million, and then $1.6 billion in 1999, representing 100% plus growth year over year for 2 years straight. But then as we can see, moving into the year 2000 and 2001, the revenue growth slowed down significantly to 68% and then 13% growth year over year in 2001. All the while too, we can see Amazon's net losses mounting year on year. In 1997, the company lost $31 million, moving up to $125 million, then $720 million, and in 2000, a peak of a $1.4 billion loss. I can almost be sure of it that many Amazon investors and bears were talking about how Amazon is a dead growth story, the stock is done, it's going to the floor, the company's bankrupt. But then finally, following the recession, things started to turn around for Amazon in terms of both profitability and revenue growth. We can see that Amazon's revenue growth re-accelerated from 13% to 26% in 2002, and then it re-accelerated even further moving into 2003 at 34% revenue growth year over year. Furthermore, from 2001 to 2003, Amazon's net income went from negative $567 million to negative $149 million, and then positive $35 million of net income. We can also see that in 2001, Amazon's price to sales ratio plummeted to a low of 1.3 and then started re-accelerating again in 2002 to 2003, which then went up to 3.9. So now what's the point of learning all of this about Amazon? Well, I could be totally wrong here, but I personally believe we are in this time in the market where Amazon was back in 2001. After Amazon's most recent quarter in 2022, we saw that Amazon's revenue growth plummeted to the lowest level it's been in over 10 years. And the same thing goes for Shopify, where they just saw revenue growth of only 22%. Meanwhile, last year in the same quarter, they had 110% revenue growth. So naturally, there are going to be so many doom and gloom headlines back like there were in 1999, talking about how all these growth stocks are dead, there's no more growth for e-commerce e-commerce is a thing of the past, and there is no way that these companies will ever grow into their valuations again. But I believe that once we get through this difficult period in the market, once the comps start getting a little bit easier, we're going to see companies' revenues re-accelerating, especially for those that are internet-based and e-commerce based. Just like Amazon saw a re-acceleration in revenue growth from 2001 to 2003 and basically for the rest of its lifetime. And eventually we will see stock prices recover accordingly as these companies' revenue growth rates re-accelerate. Now if we take a step back and just look at a chart of Amazon's revenue versus their stock price over time, this is what it looks like over this 6-year period. Look at how drastic the swing in Amazon's stock price split adjusted was over this 6-year period. This doesn't even account for the highest highs or the lowest lows in Amazon's stock price. It's simply a reflection of the stock price at the end of each year shown. And as we can see, yes, there were a few bumps in the revenue along the way, but overall the trend is upwards and the company was steadily growing over this period. So now here are 5 key takeaways and lessons learned from this Amazon stock analysis in today's video. First of all, Amazon stock never fully recovered to its previous highs of $112 per share in 1999 until nearly a decade later in 2009. And the lesson that we can all take away from this is that dollar cost averaging into our highest conviction positions on the dip is the best way to see faster returns. By lowering our cost basis and buying the dip on Amazon stock back in 2001 or 2002, we wouldn't have to wait all the way until 2009 to see new highs again. Now the second key takeaway is that Amazon's revenue growth slowed down massively to 13% in 2001 but re-accelerated in later years. And the lesson that we can all take away from this is that just because a company's revenue growth is slowing down does not mean that company is dead. And I like to compare this to Shopify stock, which saw 57% revenue growth in 2001, but then in the most recent quarter in 2022, this did fall to 22%. And like I've been saying in my videos, Shopify's revenue growth will re-accelerate over time, and I'm sure this will happen as exemplified by Amazon's business model in the past. The third key takeaway is that Amazon's net losses grew to the worst levels in 2000, but then improved to profitability by 2003. So the third lesson that all of us can take away from this is that just because a company isn't profitable at a given point in time does not mean that it's a bad investment. Back in 2001, Amazon was arguably one of the best investments in the entire stock market, yet it was unprofitable at that time. However, I should mention that there is always a lot more risk when it comes to unprofitable businesses, and you have to look at the balance sheet to figure out if that company has enough cash to survive. And in Amazon's case, it appeared they were quite well capitalized. The fourth key takeaway was that Amazon stock was incredibly volatile over this 6 or 7 year period, despite the business continuing to grow year after year without a gap. And the fourth lesson that we can all take away from this is just to ignore the volatility and focus on the underlying business fundamentals. No company is going to have a perfectly smooth revenue growth trajectory over time. There will be years where it's going to be higher or lower than the previous year, but that does not mean that the company is a bad investment anymore. And the fifth key takeaway from this analysis is that Amazon lost more than 90% of its shareholder value back in 2000 to 2002, yet long-term investors still got rich. So the fifth lesson here is that patient long-term investors will be rewarded if they continue holding shares of strong, fundamentally sound businesses. In times like this, I believe it is so important to focus on the long term and ignore these short-term stock quotes, because we do not need to sell right now when the prices are so depressed. We can hold on to these businesses as long as we want. And like many of you watching out there, my time horizon for stock picking is decades out into the future, so there's no reason why we shouldn't be buying the dip during these periods where we're seeing huge discounts in the market. In conclusion, I believe that this period we're seeing right now is very similar to the period where Amazon was in back in 2001. Amazon's revenue growth rate hit an all-time low, they were seeing losses like never before, and the stock price was at an all-time low as well. But patient investors who continued dollar cost averaging into the stock saw very handsome returns over the next decade. So that is my important message to you guys as investors. Continue sticking the course. Don't be worried about this market volatility. Just think about the underlying fundamentals of all of the businesses that you own and look for strong mode businesses. Anyways, if you did enjoy this video, don't forget to drop a like and subscribe if you did enjoy this type of content. I will be putting out a lot more stock-based content in the future. But with that said, I will see you guys in the next one.